What's up, traders? Andrew O'Connell here with Pristine Capital. Welcome to your market recap video. It is October 24th of 2022. Let's dive into today's price action. We also had a ton of news for today's session. S&P 500 finished up 1.22%. We had our NASDAQ QQQ finishing up 1.1%. Our IWM small caps finished up 0.43%. Our dogs of the Dow have been leading, and I noticed a bunch of headlines now detailing how the Dow Jones has been leading. So I would imagine the outperformance is about to come to an end, but we'll see. The ARK Innovation ETF was down 1.25%, and our TLT long bond ETF was down 0.83%. I was taking a look at the price action for the 30-year Treasury futures, and we have had 12 red candles out of the last 14. It has been a relentless sell-off in the Treasury market. In terms of the day's range, most indices did close towards the upper end of their range. Volatility expanded despite, it's kind of odd actually. Look at this. Volatility expanded in all of the indices that were green. Volatility contracted in the ARK Innovation ETF, which was red. Weird stuff. IWM small caps had 60% advancers. Overall, we had 59% up volume, and the trend model remains at a +3 reading. Let's go through today's economic data as well as the news. Basically what we saw at 9:45 a.m., we got some global PMI flash data, and it came in lighter than expected. Whenever you're looking at this PMI data, always note a reading above 50 is an expansion in the economy, and a reading below 50 is a contraction. So we're in contraction territory for these manufacturing numbers, for the services numbers, and we were below consensus on both. Now we know every day as we're looking at the economic data, I wake up very early, I look at the European markets, I look at the Asian markets. Europe is in a horrible recession, and we know China's been in a horrible recession. Now the United States is starting to enter a recession as well. So we're in this weird twilight where the last inflation print was still very hot, but now we're getting this recessionary, deflationary data beginning to come in. And it's just this weird in-between period. So we'll have to see what happens. We're going to be getting some earnings coming out tomorrow. We're going to have Google as well as Microsoft reporting. It's going to be interesting to see if those companies start reporting recessionary earnings numbers. We'll have to see what happens. This was another huge headline. We got a letter to Biden. 30 House Democrats sent an urgent letter to President Biden on the Ukraine war ahead of the midterm elections. And take a look. This highlighted portion is the main gist of it. For this reason, we urge you to pair the military and economic support the United States has provided to Ukraine with a proactive diplomatic push, redoubling efforts to seek a realistic framework for a ceasefire. And they also mention here, this is consistent with your recognition that there's going to have to be a negotiated settlement. So it does appear that we're starting to see some pushback on this Ukraine-Russia United States war. And that can really impact the global financial system. I mean, if we do get some sort of peace agreement or a ceasefire or a settlement, that could put on some more deflationary pressure. On the other hand, if this doesn't work out, we could end up in a tail event where we could have an escalation of the war. Potentially the United States has to get involved. This can just go in so many different ways. And that is why I think it's super important, while we always do look at the technicals of the market, I think the reason why a lot of technical traders have been thrown off is because the market has not really been trading off of technicals. It's really just been we're getting one catalyst after another, one shoe dropping after another, UK pension crisis. Last night we had a blowing up of the Chinese equity market. President Xi Jinping is consolidating his power. And those markets, they had a really rough go of it today. Apparently on the Hang Seng Index and Hong Kong markets, it was the worst session since 1992. So every day we're getting bombarded with some sort of new news catalyst, event, financial market debacle, whatever. So that's why we've gotten this price action that's just kind of all over the place. So I really think it's important to watch these catalysts. Then, of course, on Friday, we got this Fed pivot, pause, whatever you want to call it, and that is still in play. VIX futures term structure. It is becoming more and more flat on these front 2 months, but noteworthy, the VIX is still very elevated. We got to remember the VIX rose today despite the positive price action. Now, again, another just tape bomb hitting Tesla. In the overnight session, we got the news headline that Tesla was going to be cutting the prices of 2 of its models in the Chinese market. So that stock was down like close to 7% at one point on the session before reclaiming a lot of those losses, only finished down 1.5%. Pretty much everything else, though, some nice green action. In terms of our sectors, what did we see? We have a couple areas of the market that are topping the leaderboard. XLE is in our top momentum slot, followed by the MSOS Cannabis ETF, followed by Aerospace and Defense. This is another potential landmine. If things escalate, we don't want to see this Aerospace and Defense ETF leading. Let's put it that way. What else do we have? In terms of the strongest areas of the market for today's session, we saw transports up 1.75%. What else did we see? We saw blockchain assets did pretty well. Telecom up 1.54%. And healthcare was actually our big winner, up 1.93%. Now on the bottom end, look at this. KWeb was down 14.17%. I do want to point out the learning lesson here is that KWeb was already in one of our bottom momentum slots before this big fall. So definitely noteworthy, really just important to make sure that you're concentrating on those high momentum areas of the market. Style factors. What did we see? Momentum was up 1.3%. We saw Minvol up 1.34%. We saw high div low vol up 1.01%. What did we see for high beta? High beta was up 0.72%. So definitely a more, I would say, like a defensive configuration going on here. In terms of trades, we did do 2 common stock trades. We took another target on our AEHR common shares. We had paid $15.61 for this position. We closed it out for $21.84. We're now down to the remaining 50%. This one has just been a very nice winner. And especially in this market environment where things are so precarious, to have a stock that's moving out like this, really good. So I just figured, let me take off a piece of this because we never really know what's going to happen in this market environment. And then I closed out 20% of the Mara common shares for $12.90. I had paid $10.89. So same deal here. These were 2 large positions. You can see the 3 stars behind both of them. And really just trying to be as prudent as possible in taking a target there. And you can see AEHR, this one, very nice move as we zoom in a little bit. Really just moving out. Look how extended away it is from the 5-day EMA. Could we end up retesting that 5-day EMA? Absolutely, which is why I decided to take that target. And then Mara, this one looks like it's a little bit fresher in terms of the breakout. But I mean, look at this downward trend channel, team. Look at this. So let's just draw it very crudely on the chart. We'll put it right here, somewhere around here. Basically we've got this downward trend line. Maybe we just broke out from it. Who knows? But yeah, we're getting the breakout from the monthly value area. That's why I just took off 20% of it. Still looking okay. Now let's take a look at what we had going on here. So I want to show you the dollar index opened up the day green, and it ended up finishing out the session with a slight red day, only down 0.02%. Now, if this is a dollar topping process, then that is great. It's exactly what we want to see. We want to see lower highs in the dollar, and we want to see this continue to just roll over. But again, we keep getting a new catalyst every day where it's like weakness abroad. This broad market, just blew up or whatever, and it keeps leading people back into the dollar index. Now, our 10-year Treasury futures, these finished out the day slightly in the red, you can see, but we're still above the lows from Friday. So you can look at that, either glass half full or glass half empty. Not really making much of a move there. But the ZB 30-year Treasury futures just continue to make new lows. And this, again, was where I said 12 of the last 14 candles have been red. So the equities, the way I see it, they're kind of living on borrowed time for as long as we do not get any rally or bounce in treasuries. At this point, with data showing that the economy is starting to slow down, I don't see why we can't get a rally in the bond market. That's typically the way it goes. When the market is seeing weak economic data, when the market's seeing perhaps evidence that inflation could be slowing, these treasuries should be rallying. So it is very odd that they are not. Typically, it's just that very one-for-one economic data connection. There's not much there. But it does seem like we're still in this global liquidity crunch where it's just people are selling their treasuries to get dollars and basically raise cash. Now, take a look here. Let's go over to Tesla. And remember, we talked about that news out of Tesla. They were going to be slashing prices of 2 of their models in China. What I want to emphasize here is this rally off the lows has been very uneven. We're about to go to the S&P 500, and you'll see that we've had about an 8.7% rally off the lows that we made about a week ago. Whereas the ARK Innovation ETF, it's only up about 5% off the lows. This is the ultimate culprit right here. Stocks like Tesla that haven't had any bounce. There's been idiosyncratic risk here. But with Tesla, we got the bad news, whatever you want to call it, and we ended up putting in a green candle. It's not too shabby. Also, we have to remember that the Twitter deal is likely going to close on Friday. At this point, it's kind of funny. A month ago, no one believed the deal was going to happen. Twitter was at like $35, and it was like, yeah, it's not going to go through. No one wanted to buy it. That's where we were buying it for an merger arbitrage play. Ended up selling our position at maybe like $52. Now I feel like everyone wants to like buy Twitter for the merger arbitrage trade. There's not really much meat on that bone in terms of risk reward. Trading at like $52. If some Hail Mary event happens and the deal doesn't go through, your risk is all the way down into the 30s. If the deal does go through, which is very high probability, then your reward is up to $54.20. So very low reward, but very high probability of getting that reward. Now let's take a look at our S&P 500. We're trading at about 3805.5. And look at this. On our last rally, we got pretty much up to these levels before rolling back over. Now here we have to ask ourselves, are we going to do the same thing? And I think it's important to look to the catalysts. The catalyst primarily for tomorrow is Google earnings and Microsoft earnings. I do believe if those come out pretty solid, we could find ourselves at 3,900 before we know it. And remember, we're already up about 8.5% from the lows. So if we were to reach that level, all of a sudden it's like we're rallying, we're already 11% off the lows. I do think the interesting dynamic going on here is I think institutions have been buying, pretty much everything along these levels. I think this has been like a huge, just dipping our toes in the water zone. But I think retail investors specifically are very traumatized. I really think there's been very little participation in this 8.5% move off the lows. I do believe what will likely happen is if these earnings come out good, I believe most retail investors and traders will start getting excited about the market pretty much right as we're hitting resistance at around 3,900. So it's just kind of crazy how the market ends up working out that way. NASDAQ is challenging this bottom of the monthly value area, but we're not quite there yet. Our Russell 2000, you can see we're also putting in just a basing pattern here. Could have a sharp move to the upside. I think this point of control also within striking distance at 1823 for the Russell 2000. And then our Dow Jones. This index has energy stocks, bank stocks, companies that are much less impacted by higher rates or even positively benefited by the higher rates. And you can see this is already above that monthly point of control and above the 50-day simple moving average. Now I want to point out there's an entire group of stocks such as the global E's of the world that have not even really moved off the lows. There's been no bounce. They might even be trading lower than they were before. So the global E's, the Unities, I'm sure like the Palantirs, like all these stocks, there's been a lot of stocks that have been left behind by the rally. DigitalOcean, names like this. So it's very weird. At the headline index level, you could already be making the case that, hey, this rally's a little bit long in the tooth. We're already up like 8.5%. You know, what more can we squeeze from this? But there's entire groups of the market that have not even participated at all. So I think heading into tomorrow's session, we really just have to be cognizant of the Microsoft and Google earnings. I do believe if we get like a strong push higher into the event, you know, during the session, you can probably look for some mean reversion trades. I think same thing goes if we sell off hard into the afternoon, you can probably look for some mean reversion trades into those events. But I don't really see the market just having, you know, some huge move ahead of these binary risk events. With that said, thanks so much for watching the video. Please like, share, subscribe to the channel, comment on the video. We'll see you all next time.